Good morning, everybody, and welcome to this Q2 presentation of Hafnia's results, which are out this morning. Welcome to you, Michael Skov, CEO. We will have this usual conversation about the results, and don't worry, we'll take all the questions that has come in, and if not, we will answer them on the chat later on if you have any relationship to that. And we'll take you through the sort of presentation here. It will be about the Q2. It will also be about the industry outlook, and we know there's many questions about that. So of course we'll dwell on that. But welcome, Michael, and nice to see you.
Thank you. Likewise.
And let's kick off by this Q2 key highlights, and then we'll dig into it. Welcome.
Thank you.
Can you see the slide, Michael?
No, they're not coming up yet. I can see a lot of. Hold on a second. Let me just get in here. Here we go.
Just have to go on the presentation side.
There we go. Yeah. Thank you. Yeah. So, I mean, as you can see from the highlights that we have sent out this morning, we've been through an extremely strong second quarter, and the strongest first half result in the history of Hafnia. So I think that kind of in a way underlines the strength of the product tanker market that we have now seen over an extended period of time, and which, as we are also communicating today, we still think will continue for quite a while, since there's a still very healthy supply-demand balance, and we see a market that's still pretty tight in terms of available ships versus the demand for vessels in general. So a very strong result, and obviously I'm very happy again to say that we are paying out 80% of the net profit in dividends. So again, the highest dividend payout as well in the history of Hafnia. So I think all in all, it's been a great quarter, and we're on our way to a very great year for Hafnia the way it looks at the moment.
And can I just dwell on that dividend for a moment, because that's, as far as I know, the first time you're getting into the 80% territory. Is that correct?
No, we also did that the last time.
Okay, sorry.
Yeah.
Okay. So
we're obviously approaching now. I mean, for the ones that are not familiar with the dividend policy, it's based on Hafnia's net loan to value. And as we're reporting coming out of this quarter, we're at 21.3%. And the way things are going now, obviously we're not far away from coming below 20%. In which case, our dividend policy will indicate that we will go from 80% to a 90% payout of net profit.
Good. Let's continue. This is sort of the more broad outlook, but for those who are pretty new to Hafnia, maybe it's a good idea that you just give us a few highlights, please.
Yeah. So Hafnia is all about product tankers and transportation of refined oil products. So we are one of the largest operators, owners in the world of product tankers, and as you can see, bottom left, we financially control roughly 130 ships, product tankers, and in addition to that, we operate approximately another 80 ships from other owners that are basically giving the ships for us to manage. So all in all, is on an average basis, Hafnia operates 200 plus product tankers in the global market for refined oil products. As you can see on the next one, the net asset value by the end of Q2 this year was $4.5 billion, so quite a big increase over the last couple of years. And one more thing I just wanted to highlight, that despite the fact that we just listed in New York as well, is that we're both listed in Oslo and New York, so we have two stock exchanges. And we may get into this a little bit later, but for us, it's been super important to cater for both sides. We think there is a different type of investors that prefer New York versus Oslo, but as a combination, we feel it's the right way to be positioned as a listed company to get the optimal reach to all investors in general. The average age of the fleet is 8.8 years, and I think this has to be seen in context that the entire global fleet of product tankers is more than 12 years on average. So we have one of the most modern fleets global amongst the people operating in this segment.
Perfect. Yes, and this perhaps a little bit on your active management also, please.
Yeah, so I think for those that don't know Hafnia too well, it's a relatively young company. It was basically founded back in 2011, and if we fast track Hafnia to what you see today, it's really a combination of a lot of activity, both in terms of acquiring vessels, but also in terms of merging with other companies, acquiring larger fleets. So you can say that the Hafnia business strategy is very much based on what we call active management, which is to continuously be out there, expanding, trying to grow the business in a responsible manner. And if you look at the timing of most of the acquisitions that we've done, the majority part of our growth came in 2019 to 2021, when markets were pretty low and pretty bad, which means that our acquisition price, the ships that we bought, the companies that we merged with, etc., were all done at very low levels. So we're benefiting without any doubt. And one of the reasons that we have a great result for this year as well is that we came in at low levels. We had low entrance pricing. And because of that, we are now harvesting of, let's say, of good active management and good timing on the acquisition of vessels overall.
Then perhaps let's go into the industry outlook, because I think that's on everybody's mind these days about the tanker market. So maybe we can take these and dwell a little bit more on these today.
Yeah. So this slide may be a little bit busy for people in general, but it's really just to illustrate that the way we see the market today is that we've seen a lot more oil on the water in general. We are seeing inventories that are historically low still, which means basically that any demand we see in general that comes on top of today's level will all hit the transportation market. So we're not seeing any draw of inventories. We're not seeing any inventories built. We're actually just seeing a market where we have low inventories, still great activity, great freight rates, but any additional demand that we're going to go see going into the winter market will mean increased transportation. It will not come out of existing inventories. So that's a little bit on the demand side. So we're probably, and I've said this a few times before on these calls, that in general terms, the market got caught up by, I would say, a miscalculation of what is the demand, the global demand for oil in general. So I think a lot of people back in 21, 22 had the view that oil was on a downward slope, that we had reached peak oil demand in general for the world. And that's turned out to be a wrong assumption. So one of the reasons we have a very strong market is that oil demand came back and continued to increase, but we had underinvested in ships. So that means that suddenly you're seeing an increasing demand versus a more stable supply of ships. And this is the fundamental reason why we've seen now for the last 2 years an extremely strong market. Maybe too, if you go back to the other one, I just wanted to give one comment to the one on the right side. And I've seen there are a few questions in the chat box as well around what do we think about the Red Sea? What do we think about the war in Ukraine, etc. And at least just to give our perspective, I'm not going to comment on the length of the Red Sea crisis because it's obviously very difficult. What I would like to highlight is what you see on the right side of this graph, which is that even before we had the Russian-Ukraine conflict, even before we had the Red Sea conflict, the markets were already very strong, right? So the fundamentals I mentioned before were already giving us a very strong product market. So even in a normalization of the Red Sea situation, we're not going to see a market that drops to your historically low levels or anything like this. We're going to see an adjustment, but you're still going to see a market that's going to be super strong for the right reasons. Our view on the Ukrainian-Russian war is that the trading lanes that have changed since that war started, which basically means that Russian oil going from Russia into Europe on very short distances has been replaced by oil coming from further away, which means, again, longer ton mile and higher freight rates. We don't see that changing even post a ceasefire, even post the war ends. We think that there's decision been made that Europe is never going to go back to be depending on Russian oil. And therefore, in our view, those trade lanes are here to stay. And the value on the freight markets from those changing trade lanes are here to stay and will not go back to what they were before, in our view.
We'll get back to that point, Michael. I think there will be many questions on that as well. Do you want to comment on this cargo volumes and ton mile effect as well?
Well, these graphs, they basically reflect some of the things we said earlier, that we are seeing higher cargo volumes and ton miles in general. And some of that, of course, comes from, instead of going through the Red Sea, you go south of Cape of Good Hope. But it also indicates in general that the trend we've seen over the last 10, 12 years, which is that oil travels further because of refineries being closed down close to the consuming areas and replaced by new refineries further away where the oil has to end up and being consumed, is continuing. So we don't see any changes in the ton mile, and the cargo volumes will continue to go up for those reasons.
And I guess this is one of the slides illustrating this, that there's been a lot of activity on new refineries coming in.
Yeah, exactly. And we are only starting to see the full effect, as you can see on the left graph. In 2024 is really where all these new refineries in the Middle East and in West Africa are growing up. They're all modern, they're massive refineries, and they're built for export. So we are going to continue to see strong influence on the freight market, driven by those particular modern refineries being located further away from the consuming areas. And on the right side, that's just illustrate basically what I said before, right, about the inventory and the world oil demand, that we've seen a drawdown of inventory, but at the same time, we've seen oil demand on a steady increase after the pandemic to go higher than what we saw before we came into the pandemic.
Yeah, that's a very widely misunderstanding, that the demand for oil overall is going down. Actually, it's going quite a lot up. Is that a fair comment?
Absolutely. And I think if you look at most analysts today, again, these things are always difficult to predict, but what we're seeing is that peak oil, i.e. the peak of oil demand in general, has been moved further out. And I think in general terms, it's probably around 2030, if you look at consensus among analysts. But I think more interesting is that even after 2030, the general consensus is not that oil demand will start dropping. It's actually more about a stable level for a number of years further out. So I think it's becoming more and more clear that the whole transition to greener energy is going to take a lot more time than what people initially expected.
Cool. And then perhaps a little bit on this is also supply, I guess, that we're getting into here. And one of the key things is this crude tanker cannibalization that you are describing here.
Yeah.
Maybe you should just briefly introduce us to what this is.
So basically what this is, and it's not a new thing at all, is that the difference between a crude ship and a product tanker is that the product tanker is painted inside the tank so that it can take and carry cargoes that are more aggressive than the normal crude oil. So a normal crude oil tanker is not protected inside the tanks, which means that they can only carry refined oil products for a limited amount of time before it will damage the inside of their tanks and steel. So what we have seen over years is that when new ships have come out of shipyards, crude tankers that are clean because they've never carried a cargo before, that they have started taking clean cargoes as the initial voyages, if there has been a big difference in earnings between their core market of crude transportation and the transportation that we're in of clean refined oil products. So it's not a new thing, but we have been through a period where the difference in earnings between our market on refined oil products versus crude has been so big that it's actually made sense to take some of these crude tankers and put them into the clean market. So that has had an effect as well. It's taken away cargo. So despite a very, very strong, as I said, Q2 and first half, we still have an issue with these ships that have taken cargoes away. And our view is that we're now approaching the winter market. And once you approach the winter market, we're already seeing now that the crude market is beginning to move up. And once that starts happening, you're going to see all of these cannibalization disappear, and those ships will move back into the crude market. And again, have a positive effect on the refined oil transportation.
And then perhaps, this aging fleet, we have debated this many times, and that is actually one of the key reasons you are so optimistic about the future. Maybe you should just comment on that as well.
Yeah, I think what we are seeing is that one thing is that a ship gets old and at some point has to be scrapped like any other asset of similar nature. But what we are seeing, as you can see here, is that older ships are struggling more and more with the utilization. So basically, they're not being chosen as first choice for transportation jobs in general. So we are seeing that as ships become older, and we have a graph a bit later, once you hit like 20 years, basically ships are finding it very, very difficult to be traded in the global market. So when we talk about scrapping and when ships disappear from a market, it's generally around 25 years. But what we are seeing in reality is that once you reach 20 years, it's very, very difficult to trade in general. And you are going to be a lot more idle than you were, say, go back 5 or 6 years. And this is all a function of environmental pressure, clients that want better ship, more modern ship, lower emissions in general. So it's a continuing trend as far as we can see. And it basically means that the 25 years of scrapping technically has moved closer to 20 years in terms of when ships start to become difficult to trade.
Cool. And then perhaps this very important slide on the supply side. Maybe you can give that perspective.
Yeah, so for those that have been kind of following the product tanker market or the tanker market in general, has also heard me say, over the years that the fact that we didn't have a big order book and that we underinvested is one of the reasons why we have a strong market. And if you look at the top right side, there's a historical picture of the order book, new ships coming in general. As you can see, when you go back there from 2007, 8, 9, 10, etc., we have a massive amount of ships coming in. And obviously that was part of the reason why the market was low in the years to follow. We have increased activity over the last 7, 8 months in the product tanker market. And the order book today stands anywhere between 17 and 19% when you count the ships on the list. But there are two comments that I'd like to make on that is, first and foremost, if you look at the right graph, as you can see the order book on the furthest to the right, but then if you compare it to all the ships on the left side that are already 20 years, for the reason I just mentioned, you're actually seeing that the ships that are becoming obsolete earlier is actually a lot more than what we have on order today. So that's one comment. The second comment to be aware of is in today's order book of say between 17 and 19%, half of that is LR2 ships. And an LR2 ship is the same as an Aframax crude carrier. It just has the paint inside, so it can trade in both markets. But historically, 70% of those ships never come into the refined oil transportation market. They go straight into the crude transportation. So they appear on a list as a product tanker, but 70% of those are actually going to be employed in the crude trade. So you net that out from the order book, you're still looking at a super, super low order book for product tankers compared to the big phase out that you can see on this graph, 20 years, but even what's coming in the next 4 to 5 years of ships that will disappear from the market.
Guess there'll be questions about this, Michael. So, but thank you very much for this. Let's just take we don't want to dwell too much on that, but because we've been through it. Is there any comments you want to make on the numbers?
No, I mean, I think the numbers, as you said, we've been through. I think the company is in good shape, both in terms of the debt as we continue to pay down, and as I said, net loan to value is super competitive. We don't have any massive capex coming up. I think that's the key element. We don't believe in ordering new builds in this particular point of the market. So the view is still that the excess cash flow that we produce and out of the net profit will continue to go to dividends or share buybacks, depending on the share price in general.
Perfect. And maybe this coverage slide is always very interesting to see. Where are you in terms of coverage for the rest of the year? Is there anything that stands out here?
Well, I think what stands out is that we are basically now coming out of the weakest quarter traditionally, right? So third quarter is always the weakest quarter seasonality-wise, and yet we're still producing results that are way into the 30s. So I think what's important to understand is that we have already covered 45% of Q3 and Q4 at $35,000 TC equivalent. That's a super high number. So, for the year overall, we're already so far out basically in terms of coverage that we can already now say that the year as such will be another very strong year. So I think for me the main comment to say is as well that we are now approaching a fourth quarter, and we're approaching a fourth quarter coming out of strong earnings already, and we know that fourth quarter and first quarter next year season-wise will be super strong. So I think we're set up for a nice end of the year and beginning of next year.
And technically speaking, the winter market starts on 1st of November. Is that the way you normally see it?
Well, I would say that kind of depends, right? But we tend to say fourth quarter in general, but yeah, it is true. It's probably somewhere around November, particularly when things start to get cold, right? And people start to ram up inventories to be prepared for the winter.
Good. And I always find this interesting, this slide very interesting, because this is where you sort of say what's the results of this coverage in terms of numbers for the full year.
Exactly. So you can say, at least when it comes to if you look at the right side, what I just mentioned about Q3 and Q4 covered rates, if these are the rates for the full year, we are still looking at a net income of 850 million, right? So obviously quite substantial. And as I said, our view is that the covered rates that we have now are probably going to be below what we're going to be seeing in a very strong fourth quarter.
And this also brings a point out, Michael, that is that your current market value is around 41 billion Norwegian kroner, and you're making 10 billion on the bottom line. So you are approximately 4 times earnings.
Yeah.
Along with the rest of the sector. Why do you think that is?
Well, I think it's a combination. And one thing is that historically people know that the tanker business or shipping business in many sectors is very volatile, and therefore I don't think they want to give a multiple earnings that reflect the current strong earnings, but more like a mid-cycle level in general. But I think also right now, I think that there is definitely some nervousness out there. We see share prices moving quite a lot, depending on what the discussions are around the Red Sea, for instance, and there seems to be a lot of sentiment around it. Which is why, as I said earlier, it's important to remember, even before those two war crises going on, we were still looking at a very strong market, which would still indicate for Hafnia very, very strong net results and still a very high dividend base in general. So I think there's a kind of an overreaction really around the consequences of some of these things happening.
Cool. I suggest we go into questions now, Michael, if you don't have other things that you think. There's quite a few, and they are pretty detailed, some of them, but let's take them one by one and see where it goes. First of all, I think you had an accident and there's one asking for an update on this collision.
Yeah, that's right. So we had very unfortunate accident with the Hafnia Nile, and thankfully, there was no casualties on our side. All our crew got off, etc. So that's obviously the most important part. The ship, as we speak, is being emptied for cargo. So basically, there is an operation going on where we take the cargo off the ship to another ship that will then transport it to its original destination. So once the ship has been emptied, it will get towed into a shipyard, and we will go through the whole, if you like, analysis of the ship and what repairs need to be taking place, etc. But hopefully over the weekend the ship will be empty and then come into a shipyard, and from then on it's just about really assessing damages and repair work. But it's all covered under insurance as far as damages to the ship is concerned, basically.
And these questions are jumping all around, Michael, so excuse me for that, but this is the question about the share buyback versus the dividend, always an ongoing theme. And I guess the point is that the discount to NAV now is around 15%. So the ask is, or the question is, will you then reconsider this policy?
Well, I think we obviously discuss that all the time, right? And obviously there is a level where you would think that buyback shares is better than paying out dividends. So we debate that with the board basically on an ongoing basis. So at least for now, we decided to continue to pay dividend. If we see a consistent level of very steep discounts to NAV, we will for sure discuss whether you should go and buy back shares. But for the time being, as you can see, we decided to stick to the dividend. But it's obviously not carved in stone, in the sense that if we do see those discounts continue at very high discount levels, then obviously we will discuss whether we should change to share buybacks instead.
And then continuing on, this is a peer question where perhaps in some quarters your TCE rates have been under Scorpio and Torm. I guess it's not the case for this quarter, but the question is there anything that you think that the structural here is there any explanation for these discrepancies in your mind?
Well, I think one has to be a little bit careful with TCEs because if you just look at the raw TCEs as they are, that there's different definitions for companies how they present their TCEs to begin with, and if we want to use TCE as a representative of whether we are doing good or bad in commercial operation of ships, then I can say that it's definitely not the case that Torm or Scorpio are doing better than Hafnia. Because what you have to remember is that if, for instance, you have a scrubber installed on a vessel, your TC will definitely be higher than the ship that doesn't have a scrubber. But that doesn't mean that you have traded the ship better than the other owner. It just means that you've made an investment or borrowed money to buy the scrubber that gives you a TC advantage. But it doesn't mean you've traded the ship better than your competition. So you need to adjust for age of ships, different speed and consumption. And then at the end of it, you'll find out the real benchmark, which is who did best in the commercial operation of the ships. And we do that on every single quarter, and we are not behind those two companies at all. And there are other companies as well that do super well. But just to say that the TCs as a raw number doesn't really tell you anything because the ships are different. And there are, as I said, scrubber effects, for instance, that you need to deduct if you want to compare performance apple to apple.
Then let's jump to the Red Sea, because there's a question about what it will take for you to normalize things. I guess that's a very key question, actually.
Yeah, and I think for us, and I'm sure for many other owners in general, we're going to have to see a stable, very safe situation over a long, long time. And I think what everyone should kind of remember is that most ship owners are not going to be in a rush to go through the Red Sea. Why would you? You go south of Cape of Good Hope, your ship and the crew is safe. You have no problems, and it's going to be good for the market in general. So the ship owners don't have any interest in trying to push things through the Red Sea. So my view is, even in a normalized situation, most owners are going to hold off until you are 100% guaranteed and sure that the Houthis are not going to continue their own agenda. So even, I think, if agreements are being made, I think we are looking far, far out before most responsible owners are going to make that choice to go through again.
Fair enough. And then there's a question on scrubber spreads. Maybe you should just, I'm not sure everybody is familiar with scrubbers and what that is, but the question is if you're considering adding more scrubbers to your fleet.
No, we're not. So we have at the moment 15 scrubbers, and 12 of them actually came with some ships that we acquired. They were already installed. So our views on scrubbers from day one was kind of the same, that we think it makes business sense if you have container ships, if you have VLCCs, large crude tankers, if you have Capesize, large dry bulk ships that have a predictable trading pattern, so it can build up a supply of high sulfur fuel oil, because that is really what you want to make sure of. I mean, the idea with the scrubber is you can continue to use high sulfur fuel oil, which is cheaper because it gets cleaned through the scrubber before it goes out as emission. So you're saving by buying cheaper oil by installing a scrubber. But the availability is not that easy. So I think for big ships, it makes sense. You have savings, you have accessibility to high sulfur fuel oil. If you look at MR ships, medium range tankers, we just don't see the business case. We never did. First and foremost, it's very difficult with smaller ships that trade around the world to make sure you can get high sulfur fuel oil. Secondly, because you're a smaller ship, you burn less, which means the savings are less. And thirdly, the quality of the scrubbers and the spread, when you look at it, has just indicated that most of these initial calculations that were made when people installed scrubbers never made any sense. I mean, you look at the spreads in 2023, they were probably around, say, $160 in some areas, but you needed 250 to have a decent payback time over, say, 3 years, 3 to 4 years for scrubbers. So we just don't see it as an interesting feature unless you have very big ships. And the final bit I will say is that the real reason why we don't like them is that open loop scrubbers, which probably consist of, I would say 90% of the world's scrubbers are open loop. I mean, they're already being prohibited in most parts of the world when you come to coastal sailing, so you can't use them when you are close to the coast in general. And we expect there will be a total ban of open loop scrubbers in the very near future. So we will certainly not go down that route, no.
Thank you. More sort of question on your sort of cash break even with your net loan to value coming substantially down. Does that have an effect on your cash break even, and will you disclose more of that going forward?
Yeah, and we do disclose that actually in general terms when we have investor meetings, and I think it's fair to say on an average basis coming out of 2024, we're probably going to be looking at a cash flow break even of in the low 13s average for the fleet. So that's kind of what the numbers look like now, and we've always felt in Hafnia that when you are in like 13.5 with the combination of ships that we have, it's a super comfortable level, and it's a level that we've only seen broken in terms of having less earnings than 13 and a half on average. We've only seen broken, I think, 1 year historically going back. So it kind of it sets a good, if you like, a very competitive level for your cost side going forward, even if markets should change.
And on that note, with net loan to value coming down, you are 21% now. Will you be below in Q3 of the 20%, so you'll make a payout of 90%?
Yeah, well, we obviously that depends on also on, I think, on the development of the values of the ships, right? So I think on reduction of debt alone, probably not. But if we continue to see values of secondhand ships go up, then the calculation is pretty obvious. Then we're probably not that far away from being able to reach that level. No.
Okay. Then there's a very technical question, but I'll go for it. That's the operation of your 2 19-year-old LR1s and 1 17-year-old LR1 and 4 16-year-old LR1s. How much longer do you expect to be able to trade these vessels?
So it's a very good question, of course, and I think it goes back to what I said earlier about age and ships in general. I mean, we've basically gone through all of our ships one by one to try to see if we could extend lifetime of certain ships, because given the fact that we think the world still needs more ships to transport oil, we wanted to see what ships we could squeeze further out than what we would normally do. So in that context, we obviously have a list of ships that we do not think that we can stretch further, and those ships are being sold one by one as we go along. We just sold one not too long ago. So without commenting specifically on these ships, I can only say that the ships where we feel the quality is good and that has been well maintained, we're trying to extract as much life as we can. The ones that don't have that ability, in our view, will get sold before they come into, let's say, any form of critical area age-wise.
Perfect. I think actually we are reaching the end, Mike, of the number of questions here. We also crossed half an hour. I think that's well done. Thank you very much for your presentation. Thank you very much for listening. If you have more questions, please put them on the chat, and I'll make sure that they are answered. Thank you very much for attending. Thank you, Michael.
Thank you so much.